Gold at $4,936 looks like strength, but the physical market is quietly disagreeing. As I'm recording this on January 23, 2026, silver crossed $99 per ounce yesterday. Charts across trading platforms show these steep, almost vertical climbs. Social media is buzzing. Safe haven demand is spiking. But here's what I want you to understand before we get caught up in the excitement of record prices. While everyone's watching these numbers climb on their screens, something completely different is happening beneath the surface. The spot price your broker shows you, that's telling one story. The physical market, the actual metal changing hands between vaults and central banks, is telling another story entirely. And that gap between the two, that's what we need to talk about today. Let me give you a hard number to anchor everything that follows. On January 22nd, the London Bullion Market Association, the organization that sets the global reference price for physical gold trading, fixed their official afternoon price at $4,832.05 per ounce. This is the price that institutional banks use. Central banks use it. Physical traders across the world's largest over-the-counter gold market use it. At the exact same time, COMEX gold futures in New York were pricing at $4,936 per ounce. That's not a typo. COMEX is $104 higher than London, $104 per ounce. To give you context, in India right now, MCX gold is trading at roughly 1 rupee, 59,710 rupees per 10 grams for 24 karat gold, which converts to even higher than COMEX when you calculate it per troy ounce. Now here's where it gets interesting. That $104 gap, that's called a premium, and it represents 2.15% difference between the two markets. On silver, it's even more dramatic. COMEX closed at $99.40 yesterday, while London's noon fix was $93.38. That's a 6.4% premium in New York. For context, these spreads normally sit at 20 to 40 cents. They don't stay apart by 6% unless something fundamental is broken, or something is being priced very differently for a specific reason. Let me explain why this matters in practical terms. If you're holding a 100-ounce gold bar, that $104 spread means you're looking at $10,400 difference depending on which market you're in. On silver, that's $602 per bar. For large institutional holders moving serious volume, these aren't just interesting numbers on a screen. These represent massive arbitrage opportunities if they could actually move metal between markets freely. Pause. But they can't. And understanding why they can't is the entire story. In a normal, functioning market, here's what should happen. If COMEX is $104 higher than London, traders would immediately buy gold in London at the cheaper price, ship that physical gold to New York, deliver it against COMEX contracts, pocket the spread, and watch the prices converge back together. That's how arbitrage works. Gravity pulls prices toward equilibrium. But we're not seeing that happen. Why? Physical gold shipment from London to New York takes minimum 3 weeks by ocean freight. If you want it faster, you fly it. But that costs roughly $60 to $80 per ounce at current price levels. That's more than half your arbitrage profit gone immediately, just on transportation. But there's a bigger problem. According to reported data from late last year, London vault withdrawal times extended to 8 weeks. 8 weeks. That means even if a trader wanted to pull physical metal out to ship it, they're standing in line behind everyone else who had the same idea. Meanwhile, on the other side of the Atlantic, COMEX warehouses are absolutely overflowing. Inventory has grown to 43.3 million troy ounces. To put that in perspective, that's equivalent to 5 years of total US gold consumption sitting in warehouses. New deliveries into COMEX for January 2026 alone are projected at 7,750 contracts. That's up 227% compared to last year. The system is flooded with supply in New York, while traders in London can't get metal out fast enough to take advantage of the price difference. Most people miss this part. Let's check this against what's actually happening with physical metal around the world. Central banks purchased an estimated 297 tons of gold through November of last year. November alone saw 45 tons of net buying. These purchases aren't spread evenly. They're concentrated in emerging markets. Poland bought 95 tons year to date. Brazil purchased 43 tons in just 3 months. Pause. And here's the critical detail. They're not buying futures contracts. They're taking physical metal, actual bars, and they're not storing it in London anymore. London vaults currently hold 9,106 tons total. That number is up slightly, but the velocity has slowed relative to the inflows. Meanwhile, COMEX registered inventory, that's metal officially committed to delivery, stands at only 54% of total warehoused gold. That means nearly 20 million troy ounces out of 43 million total are just sitting there, stored but not allocated to any delivery contracts. That metal can sit indefinitely. It's eligible to be used, but it's not committed. In the ETF market, we're seeing something similar. Silver-backed ETF holdings surged to 860 million ounces by year-end, up 21% over the year. That's institutional money locking physical silver into warehouse boxes under legal contracts. At the same time, speculator net long positions in COMEX silver futures fell to near 2-year lows. Large traders are reducing their IR paper exposure. The data is showing us a clear pattern. Central banks buying physical, institutions loading ETFs with physical backing, futures speculators pulling back. The money is flowing into tangible metal and away from paper instruments. Exhales. That's not random market noise. That's coordination around a single thesis. Trust physical assets over financial claims. Let me explain why this matters. What we're seeing is market segmentation. COMEX is pricing gold as a traded commodity, something you can buy, sell, and speculate on with leverage. London is pricing it as a physical asset in an environment where getting your hands on actual metal takes time and effort. Right now, if you're buying on COMEX, you're effectively betting on delivery into US warehouses where supply is abundant. If you're buying in London, you're acquiring physical metal in a constrained environment where central bank demand is hitting supply hard and withdrawal queues are backing up. The spread isn't an arbitrage opportunity waiting to be exploited, it's a pressure valve. When physical supply tightens in London, traders move to COMEX for cheaper nominal prices, but they can't easily move that metal back, so the system stays segmented. This isn't a market dysfunction that signals imminent collapse. This is a stress signal, a sign that at these elevated prices, the flows between major physical trading centers are constrained, and price discovery is happening in different places for different types of buyers. That registered inventory detail matters more than you might think. Only 54% of COMEX gold stocks are registered, means nearly half the metal in warehouses isn't committed to delivery contracts. Eligible metal can sit there indefinitely. It creates optionality for holders. They can choose when or if to allocate it. But it also creates a ceiling on how much new metal can reach the delivery market if demand suddenly spikes. Now here's what the market will be watching next. First, the January delivery cycle. With 7,750 contracts projected for delivery this month, up 227% from last year, we'll see whether these eligible inventories convert to registered status or whether they stay locked away. If metal keeps piling into warehouses without converting, that signals weak industrial demand and tightens the registered to eligible ratio, which constrains delivery availability even further. Second, the next UK monetary policy announcement and whether the Bank of England continues to feel confident managing these vault withdrawal queues. As long as queues stay at 8 weeks, London remains constrained. Size. If they extend beyond that, we'll have confirmation that physical demand is genuinely outpacing refining and logistics capacity. Third, central bank purchase announcements. At current prices above $4,900 per ounce, the structural math changes dramatically. Emerging market central banks have publicly stated they want gold at 10% of total reserves. At $5,000 per ounce, the notional shift required to hit that target is roughly $194 billion, or about 1,200 tons of physical gold. For context, that's approximately 1.5 years of current emerging market purchase pace. If purchases accelerate from here, physical supply tightens even more and the COMEX London spread widens further. If purchases slow because price becomes prohibitive, that's your signal that the momentum drivers behind this rally are exhausted. The setup we're looking at today, record nominal prices on COMEX, constrained physical flows in London, soaring ETF demand, Widening spreads between major trading centers represents a market in transition. I'm not making a prediction about whether prices crash or rally from here. What I'm observing is that at these price levels, the structure of supply, demand, and logistics is being tested in real time. The outcome depends not on sentiment or technical chart levels, but on whether physical supply can actually meet real-world demand at these prices. For now, the system is holding together. It's constrained, but it's functioning. Prices are high, but deliveries are still happening. Spreads are wide, but metal is still moving, just slowly. What you want to watch going forward are three things: the flows between markets, the withdrawal queues in London, and that spread between COMEX and LBMA. That's where the truth lives. Not in the headlines about new record highs, not in the excitement on social media. The real story is in the mechanics, in whether physical metal can move fast enough to keep these markets connected, or whether they continue drifting apart into separate realities. That's the situation as it stands right now. No predictions, just the data, the mechanics, and the questions worth watching.